Everyone, it's Nick with Us versus Herd. Today I'm going to go over buying and selling a call option. I recently did one with a put, so today we're going to do a call. Twitter's down today, that's why our market's taking a hit, but our little account here over the last year, we're up almost 60%. As you can see in the last week, there's been some major ups and downs. A lot of things going on in the news politically wise, but what we're going to be doing right now is just we're going to walk you through on how to buy a call. For this example, I'm going to be using SPY here. The reason why I like to trade SPY is the volume is good. A lot of people are trading it. I can kind of show you here kind of what I mean by that. It's a little bit harder on Robinhood to find this, but if you click on one of the strikes here, you can see here, let's bring up some metrics here so I can show you, is volume on this, just one contract here has been 6,000. So when I'm looking at volume, I'm looking over, anything over 500 or 1,000 volume. You want something that is liquid because you get better pricing. As you can see here, the bid and the ask are very tight, just within a penny or two. You want something that's liquid when you're trading, so that's why I trade SPY. But let's go back just to the beginning here and kind of walk you through it. So, depending on what you want to trade, for this example, I'm going to click on SPY. I'm going to click on this little trade button down here. And I'm going to go to trade options. Now Robinhood doesn't do a great job of. They just recently added this here, saying, hey, if you buy a call, you think that SPY could go up, and then they give you some trade ideas here, short term, medium term, and long term, just for the beginning trader. One thing I will say, if you don't know how to trade options, don't learn how to trade options first before executing orders, because you may get lucky a couple times, but you're most likely going to end up losing on your account. SPY I also like, they have a lot of different expirations. They expire every Monday, Wednesday, and Friday. Most stocks have weekly options. They expire every Friday, but since SPY is so popular, they now have Monday, Wednesday, and Friday expirations. So that way you can create more occurrences. If things are happening in the week, you could take better advantage of that, better opportunities in there. So that's why. However, the opposite side of that is there's more ways for the market makers or the brokerages to take your money. So they create these products to give you the opportunity to invest, but also they create the products in hopes that you spend more money. So just be mindful of that. Also with Robinhood, they do have some SPY, since today is Monday. Today's Monday, the July 9th. Does have it expiring today, but you can see there's no July 9th on here. And the reason for that is Robinhood doesn't let you trade options on the day of expiration. So what I mean by that, they don't let you open new positions. So if I bought this on Friday for July 9th, as you can see here, I'll go to Thinkorswim here so you can see here. Here's the July 9th expiration. Here's the July 10th. And I'll open up Robinhood again. So you can see kind of example here, the expiration. So July 11th, July 13th, they have here in Thinkorswim, July 9th, July 11th, July 13th. On other brokerages, you can trade on the day of expiration. So I can open up something today and close it today on July 9th. But on Robinhood, if you opened it, let's say last week or Friday, you can only close that trade. So it will be a closing only trade. You can't open more trades for today's expiration. And I think the reason why Robinhood does that is that for beginner traders, they could get in trouble, and also Robinhood needs to protect themselves because they have a lot of newer traders on their platform that don't know how to trade options, and it could get a little bit out of hand. Options are tricky. They're not like just buying and selling stocks. There's a lot more to them. You could get assigned stock, just a lot of different variables. So the Robinhood as a brokerage most likely trying to protect themselves. Also, if you do have something expiring today or on the day of expiration and you don't close it out, Robinhood is going to close that out for you at least 1 hour before market close. So If it's worth money, they close it out. I think I had one time an SPY contract was worth a penny, and they closed it out, and I got $1 back. It's free commission, so went out. I was just going to let it expire worthless, but they closed it out for me anyways. I was just kind of testing the theory, and they even if it was worth $1, they closed it out. But if it's in the money, definitely if it's in the money, if it's worth a lot of money or worth any money, they will close it out so that way you don't get assigned the stock, because most likely exercise the stock, because most likely people that trade options, you're not going to want to exercise the stock, or if you do, you're not going to have the capital to do so. So let me just explain what that means a little bit here. So I'm going to go to the July 11th calls here. So I selected July 11th, so that's Wednesday. This is just going to be, I'm not sure if this trade is going to make money or not, but this is just for example purposes. We've been grinding up here. Who knows if we're going to continue that way. But we got the 278 call, the 277.50 call, and we got these below the share price here. The share price is currently 277.45 and on down. So below this line here where it says share price, this means that the calls are in the money. So you can see that they're worth more money here because they're in the money. One option contract, I'll show you right here, is worth 100 shares. So one contract equals 100 shares. So let's say, hey, you're like, hey, it's only 83 cents to this, but it's 83 cents times 100 shares. So what a lot of people don't understand is when you buy an option, you actually control 100 shares. So you're using leverage. So you're not trading the actual share price. You're actually, when you buy and sell options, you're trading the option price that relies on the underlying, and the underlying is actually the stock. So for every dollar the stock goes up, this contract should be worth $100 more. So let's go to a more of a round number. So let's say 278, the 278 call. If SPY goes to 279, it should be worth $100 more than the 60 cents. If it goes to 280, it should be worth $200 more. So for every dollar up, it goes up because you're controlling 100 shares, is how it works. Where things get a little tricky, if you click on this little symbol, let me go back to this little symbol up here for data. Where things get a little tricky are the Greeks. Delta, theta, these things they contribute to the option price and the premium of the price and IV rank. The higher the implied volatility, the lower the theta, all that stuff plays into the option price. So we won't go through that too much here today. I'm just going to show you how to open and close some trades. I'm not actually going to probably close SPY. It's the same as opening it. I will go through the steps, but I won't close the order because I don't know if this trade is going to make money or not. I hope it does. I'm going to leave it open. So what I'm going to do is I'm actually going to trade this 278 call. I like trading closer into the money just because you have a better chance of making money. When you trade really far out, you lessen your chance of making money. Your probability of profit gets lesser and lesser the further you're out. Depending on what your goals are, depending on where the stock is, all these contribute to that. So what I'm going to do, I'm going to open this 278 call here. So right now 60 cents. It expires July 11th. So I'm going to click on the 60 cents here. And the bid and the ask between 60 and 61. So I'm going to put 1 in there. I'm going to hit review. It's going to cost me $61 because that one contract equals 100. And hit review. I'm going to swipe up to submit. Okay, so this order got filled right away. And that's the other thing about trading liquid stocks, options, is that they get filled relatively quickly. Whether if the bid and the ask were very far apart, I probably wouldn't get it filled this quickly unless I put it out at the ask price, which is not always in your best interest here. So I got one contract, cost me $61. You will now see that contract down here. The one thing that I do like about Robinhood is that under the options page here, you can actually track the price of the option. So if you go back to the home screen here, and you can see I have this one call expires on this day, June 11th. you can see that there's a little graph here. This isn't the chart for SPY. This is the chart for the actual call. So you can see this is the price of the premium that you're trading throughout the day. So as today, you can see that it was a low of like 36. And down here, I think it probably tells you what the, the low today was right here, 34 cents. The high today was 75 cents. And that was probably when it reached this, when it was at the high, it was 277.77 today, when it was almost 28 bucks, 278, sorry. When SPY is almost 278. Implied volatility is at 9. You can see what your return is here, but it's kind of cool. I definitely like that you can chart. Robinhood lets you chart the price of the option so you can see, where you're buying here. You can see what it was like. I don't think it only does one day. The weekly doesn't work, so it doesn't track that far back. I think it only tracks for the day. What a lot of people get stuck on is the break-even price. Now, the break-even price here is $278.61. What that means is I paid 61 cents for this, or $61, times 100. So I paid 61 for this. So they're saying it has to go to $278.61. That price is if I were to exercise the options. That's my break-even price. That's not the price of the premium. So if tomorrow we wake up and it's, let's say, right in the morning, 278. Let's say it's 278.15. I most likely will be profitable at open, mainly because the IV rank is going to be high right at market open. Implied volatility is high, and if things are really volatile in the morning, it really screws the option prices up. So I'll probably be more profitable than definitely be more profitable than the 61 cents. However, if I get to the day of expiration, it's like 278.30. It's probably going to cost me more than 278.61 to be profitable on it. If I get there, it's probably going to be, close. I'll probably go close to break even, maybe a little bit under, depending on what the price is at that time, mainly because of theta. So days of theta, on the day of expiration, theta is going to eat this up alive. So you just got to be mindful of that and learn what theta does to the option, learn what the IV rank or the implied volatility does to the option, and you'll be okay. To close this trade, you just click on your option here, go to trade, and click on sell. And then right here, as you can see, I'm going to sell this one call here. You can hit 1. And I'm going to hit this 62 cents here. I make a buck. But also be mindful, you see down here the order summary says you're selling your right to buy 100 shares of SPY for $278. So when you buy a call at a certain strike price, that means that the contract means that I have the right to purchase 100 shares of SPY at $278. So even if it goes to $290, $285, I can exercise my contract and I have the right to purchase that $278. However, most likely you won't do that because why not take the profits? You'll probably be right around the same profit point anyways because you're already controlling 100 shares, depending on your time. If you want to hold 100 shares, great. If not, most people, they just trade the premium on the call or the put or the option. So most likely you're just going to trade the option, take the money. No reason to exercise stock. You can sell your option at any time. You don't have to hold on to it. Some people get confused by that. They don't have to exercise to take the money. They can sell it anytime that they want. Also be aware that options are very volatile. So when options have really big swings and when the underlying has very big swings up or down, it really jacks the option prices up or down. So just be mindful of that. May not be in your best interest to close the option at that time if you have a call that's going down really fast. If it's going down really fast, your option value is going to sink quick. If it's going up really fast, you might want to sell because then your option price gets jacked up as well. So just be mindful of that. Trade safe. Do your research. If you have any questions, definitely leave them below. Leave a comment below. Like the video, and if you're new to this channel, subscribe, and you can check out some of our other videos as well.